Good afternoon, and thank you for joining us for today's Affordable Housing Webinar, Year 15 for Low-Income Housing Tax Credit Partnerships. I'm Elizabeth Harriger, Partner and Director of Affordable Housing Services here at McKonly Asbury, and I'll be moderating our webinar this afternoon. Joining me today is our guest speaker, Penny Indictor, who is an attorney and partner at Berman Indictor, and I will turn it over to Penny for a minute to introduce herself.
Hi, and thanks, Elizabeth, and thanks everyone for joining us today. My name is Penny, and I am a partner at a small boutique law firm in Philadelphia called Berman Indictor. There's about 10 of us, and I am a tax partner there. I also have another tax partner, some real estate partners. So we come at these low-income housing tax credit deals from all sides. And we basically deal with tax credit projects, whether they're low income, historic, new markets, and projects that use, have HUD involvement, government subsidies, and so on. So I look forward to speaking with you today. Thanks, Elizabeth.
We're excited to have you. McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. We've been specializing in affordable housing, accounting, and consulting since the late 1980s, and we provide a variety of accounting services to the industry, such as annual audit and tax return preparation, 10% tests, 50% tests, development cost certifications, a variety of low-income housing tax credit consulting, and back office accounting support. You can learn more about us and all these services by visiting our website noted at the bottom of the slide. And we would love to talk to you about how we can help you or how we can work with your organization. So feel free to reach out to us. Our contact information is at the end of the presentation, and you can also find it on our website. Our thought leadership subscription, M&A and Insights, has been revised to give our subscribers the opportunity to select which topics are most relevant to them. You can scan the QR code on the slide or sign up at our website to select the information you are most interested in, such as affordable housing topics. I'd also like to take a minute to talk about our affiliate company, M&L Compliance Management, also known as MLCM. MLCM provides affordable housing property compliance consulting services and specializes in tenant file reviews and for programs such as LIHTC, Home, and Section 8. MLCM also provides several trainings throughout the year and can even provide site-specific training for your property or your staff. You can find additional information about MLCM by scanning the QR codes to subscribe to our thought leadership and or follow us on LinkedIn. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them after the webinar. For those of you that are looking to obtain CPE for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you must answer all 4 of those questions to get your certificate, which will come in an email within a month after the webinar. In order for you to be eligible, you must answer via the polling submission, and we will not accept late responses. Your answers do not have to be correct. You just have to answer. Our first polling question should be up on your screen. Do you wish to receive CPE for attending today's webinar? So hopefully people are here to learn about year 15, not just to get the CPE credit, but if you're here to learn about year 15 and you need CPE, it's a win-win today. And at this point, I am going to turn it over to Penny.
Okay, thanks, Elizabeth. Yes, so let's start. We're talking about year 15 today, and you hear that word a lot. It can mean several different things. But it, in general, is a great time to take a look and take stock of the project, where it is and what it needs to be in the best position to carry ahead into the future. This year 15, I think most significantly, matches up with the end of the tax credit compliance period, which is a 15-year period. So as most people probably know, the tax credits are generated and taken into account over a 10-year period, but the 15-year period is the recapture period. So that is what we call the compliance period. And at the end of 15 years, that is expired. So that is also a good time to look at what is going on with the project and think about, if it hasn't been done already, how you move forward with your tax credit investor. So some things to think about is, when you look at the property, is there a lot of deferred maintenance? What needs to be done? What sources might be available to do any deferred maintenance? There might be a possibility you might want to explore a resyndication, meaning apply for new tax credits and close another tax credit deal. That is a whole separate webinar, but that's something that you might be thinking about. But regardless of any of that, the first step in moving forward after year 15 is to think about wrapping up your relationship with the tax credit investor, and that's what we're going to talk about now. So Section 42, which is the low-income housing tax credit, was added to the code in 1986, and now that we're in 2026, we're on the 40-year anniversary. So there have been many exits over this period of time. The first would have been about 15 years after it went into effect, and then, things roll in over time. So the first slide, I feel, has less importance nowadays. The further we get out, the more years we have under our belt. But I will just mention it briefly. So there have been some changes. So if the only exit you may have been exposed to was a long time ago, you may notice there's some changes in what we think about. For example, in the beginning, when these deals first started, there was not an extended use period after the compliance period. And now we have extended use periods. So even though the tax credit compliance period ends, affordability will continue. And in Pennsylvania, that is a 40-year period total. So that is something that's different. So if you had looked at an old one, you might not have to think about continuing affordability, but now you would. The same applies to qualified contracts, which is a mechanism whereby there's a potential to get out from under these continuing affordability restrictions by approaching the state agency and asking them to seek a buyer subject to the affordability restrictions. And if they can't produce a buyer, then the affordability restrictions would lapse. So back in the first round of deals, and for a while after that, that may have been an option to be considered in year 15. However, in most recent years, qualified contracts don't have the level of importance they used to, because especially in Pennsylvania and other states, you waive that right when you apply for tax credits now. So that for more recent deals, that's not something that can be tapped into. There's also been some changes over time to the related party rules. When I talked about perhaps doing a resyndication of the deal, that would involve to a significant extent acquisition credits, and there are some related party rules there, and they've changed over time. So now, back if you had done one prior to 2008, there was the availability of a 10% overlap. So the seller who's selling to the new buyer in a resyndication transaction couldn't overlap by more than 10%. So there was definitely some structuring to be done there. That has increased now to allow 50%. So there's still limitations on the overlap between the buyer and seller, but it's more favorable to doing a resyndication than it used to be. And also there have been, evolution of the business deal between the general partner, the developer, and the investor. So back, if you looked at an older deal, there may have been cash flow and capital transaction proceeds being split 50-50 between the investor and the developer. And in more recent years, as things have evolved, you would more typically see something along the lines of 90% of the back end and the cash flow to the developer GP and 10% to the investors. So, all these things play into year 15 and what the property may be worth and what the affordability restrictions are going forward. So those are just some things just to set the stage, things that have changed over time. And as I said, as we get further along, those old deals probably you won't see anymore. And this all becomes, just kind of background. So let's move on. I will try to, okay, there we go. So this is just talking about the perspectives of the developer and the investor when we get to year 15. So I think I think we start with the premise that there's a lot of common ground. Developers and investors probably agree that the investor should exit at that time if they have not already done so. The developer would be motivated because under the partnership agreement as it stands, there's a lot of things that they can't do without investor consent. So it's constraining on the day-to-day. For example, they can't incur new debt or refinance debt or take withdrawals from reserves or make various, operational decisions that require the limited partner consent. So from the developer's perspective, it would be great to have the limited partner exit and not have to jump through those hoops anymore going forward. There's also reporting requirements that investors require. So there's tax returns and financial statements and rent rolls and various correspondence with lenders and agencies. So when the investor exits, that is not required anymore, most likely after year 15. So that's a plus. Also, there's fees that go to the investor, like asset management fees that can stop being paid if they exit the deal. So the developer definitely has motivation to get the investor out. The investor also has similar motivation to get out because here it is, the end of the credit period, the recapture period's over. They've gotten the credits that they, bargained for. They, have gotten what they've underwritten, and there could be all other kinds of reasons. They don't want to do the bookkeeping for this project anymore. Maybe the project is struggling and it's better. They want to walk away, as soon as possible. So the investor definitely, and the investor has probably made promises to the developer GP that they will exit smoothly at the end of year 15, and they certainly consider preserving their good reputation following through on that. So we start out with the idea that, everybody wants to come together and get this deal done at year 15. But then we get into the push-pull sort of where people may differ on the important question of how much should this exit cost everyone and how best to accomplish it. So from the developer's perspective, obviously they think, well, we gave the tax credits, the investor got their tax losses, anything that they bargained for, they got. They're supposed to exit, and they should do so, for a nominal amount. The investor's view may be that, that they have to take stock. What is the value of this project? Is there some back-end value that they should participate in? The partnership agreement certainly provides for that, and we'll go into why that is a little bit later. But so the investor may not share the enthusiasm for the developer to get out for a nominal amount. And so therein begins the negotiations of arriving at a price that will make all parties equally happy or unhappy and allow everyone to sign the right documentation and move forward. Okay. We have a polling question. Let's send it over to Elizabeth.
Yes. So which of the following is a reason why a developer would want an investor to exit a deal? Limited future cash flow, reporting requirements, ongoing losses, or reputation. That third one should say ongoing losses, not ongoing issues, although that would be a reason. So which one of those would be a reason why a developer would want an investor to get out of the deal? So we'll give you A few more seconds here to answer that question. So we should be able to close the poll. Yes. So the reason would be reporting requirements. You know, you have these audit requirements, these tax requirements, maybe other operational report requirements that the investor requires every year. And if the investor exits, then those, to a large degree, those requirements go away. I mean, you obviously will still need to file a tax return of some sort, whether you remain a partnership or not. There are still tax implications, but you wouldn't have the same, perhaps, early deadlines that you have with when you have an investor in the deal. You wouldn't have the same financial reporting requirements. So that would be, the reporting requirements would be why. So Penny, back to you.
Okay. So I guess as a general matter, which you all probably would know, is that as a general matter, if there is no back-end value to a deal, then at this negotiation, for better or worse, this negotiation becomes easier. If the investor acknowledges that there really is no back-end value, and Elizabeth and I were talking before just about, well, what does that really mean? And just in very general terms, to determine the back-end value, you would get an appraiser or a broker to get a valuation, and then you would look and see what the obligations of the partnership are. So you would have a value, but then you might owe 5 different lenders outstanding debts. So you would try to figure out is there any excess after you pay all the obligations of the company. Is there excess? And that is sort of what people are negotiating over, what the excess might be. Yeah, so you would definitely want to, start that process, because until you really know that, you don't really know what you're negotiating. And I did want to say, and I think you've probably experienced this if you're in this industry and doing these types of deals, that a lot of times the developer-investor relationship really may play a role in the negotiations. So the industry is a small industry, and it's really built on relationships that last from signing up the deal through the closing process, through the construction process, operating the project and asset management, and then to the exit. So there have been, interactions, different levels of interactions for like 15, maybe even more than 15 years, because you had to close the deal, sign up the LOI and the deal, and then go through the whole process. So there's been a relationship that's been built between the developer and the investor, and hopefully that's gone smoothly. But some of it, can really depend on the deal, and the ongoing relationship between the developer and the investor. So if this is a developer that's doing multiple deals and has done multiple deals with investors, there may be opportunities, that you can look at those deals as a whole, and maybe one deal would be easier to exit because the investor knows there's some other deals coming down the pike. And so it all kind of plays into each other. And also, if the developer and the investor plan on doing business, or the investor would like to do business with the developer going forward, there's a big incentive to follow through on exiting, in a smooth manner. And that really helps going forward for the investor. And they certainly don't want to impact their reputation by, causing unnecessary difficulties, because that just impacts their ability to do future deals. So all those things are coming into play when you're, starting this negotiation process. So the next thing I thought I would go over are a few basic tax concepts that I think will come into play when we get further into the discussion. But I thought I'd lay the groundwork here so that when we refer to them, we'll know what we're talking about. So let's look at some tax concepts, because you'll see through all of these deals, there's business concepts and then there's tax concepts. And sometimes one may impact the other in ways that you don't intend, but yet have to work that way because that's just what the rules are. So when we talk about exit taxes, that is a big word. It comes really into play very significantly when you're trying to calculate, what should the investor's exit price be. It comes in as a factor and a component of the calculation. So most basically, exit taxes are triggered by a negative balance in the investor's capital account. And in the most basic terms, a capital account is sort of it's a record keeper. It goes up, it gets increased when the investor makes a capital contribution to the partnership, like at closing or at completion, or however it is described in the partnership or operating agreement. And then it goes down by distributions it may receive, and also tax losses, including the biggest one in these projects is depreciation. So you may have an investor that puts in $1 million and then will have $1 million capital account, but over time and depreciation, that capital account will be diminished. It will be decreased. So there are things in the tax law that might allow an investor to keep taking losses even beyond the balance in their capital account. And that is how a capital account could go negative. So if there was $1 million contribution and $1.5 million of depreciation over time, then at the end of the 15 years, you might have a negative capital account of $500,000. And because you've taken those losses, the tax rules say that when you dispose of your interest, you have to recognize that $500,000 as income. So that's what an exit tax is in general terms. It is the negative capital account balance multiplied by the investor's tax rate, which is mostly 21% if we're talking about a big corporation. So what we want to do is make sure that we're aware of what the investor's capital account is projected to be over time. We just want to keep an eye on it. Because if the more negative an investor's capital account would become, the more the exit taxes would be, and the more that impacts your exit price. So it's important to keep tabs on that. There are ways, and so if we do keep tabs on it, if we're aware of it kind of upfront and then we monitor it over time, there are ways that we can sort of minimize the negativity there. So there's different things we could do. So if we know that in year 11, after they've taken all the tax credits, their capital account's going to go negative, and we don't want it to go excessively negative, we could provide something along the lines of, in year 12, if the capital account's negative, we're going to switch some allocations so that maybe some losses go to the general partner instead of the investor, and that can actually help the investor's capital account either stay positive or hover around zero and not go too much negative. There's also different other things like one of the more important one is, so if there's related party debt where you're in control of setting the interest rate. So if you as a sponsor got a grant and you're going to take those funds and loan them into the partnership, then you can pretty much set the interest rate. And if you set the interest rate lower, that will generate less interest deductions, and that would be less losses, so that the investor's capital account would be less negative. So there's things that we can do up front. We can negotiate things into the agreement, possibly. And also over time, if you notice things are getting negative, you might take another look and try to bring it to people's attention and try to figure out what to do about it at that time. So anyway, those are exit taxes, and we'll refer back to that. So let's move on. Okay. So there are some, like I said, there are business concepts and there are tax concepts. So there are certain tax concepts that influence investor exit provisions. So the first one is to just kind of distinguish between a lender and an equity investor. Most people are pretty familiar with a lender and what their documents look like. So a lender makes a loan. They generally take a security interest, a mortgage against the real estate. So if something goes wrong and they're not repaid on time and they wanted to, they could foreclose on the property and take the property. And there's usually multiple lenders in these deals, and there's a certain priority, and maybe there is a recording order. So one mortgage gets recorded, then the next, then the next. So all the lenders kind of know where they stand. They know what their priority is. They know that if there's a foreclosure, they would receive money in this certain order. But the equity investor is totally different. So there's no loan documents, there's no mortgage, there's no real security. An equity investor is governed by entering into a partnership agreement with the developer. So it's a whole different set of considerations. And the reason it is that way, instead of them just taking the equity and lending it, is because under the tax code, tax credits are allocated to partners in a partnership. They're not expected to be sold to a purchaser of tax credits. And we're talking here about federal low-income housing tax credits. There may be some state credits that are certificated and sold, but that's not what we're talking about here. So there needs to be this partnership, and the tax investor needs to be treated and respected as a partner for tax purposes. And they will get a tax opinion from their investors' counsel that concludes that. So that's why they're looking at all these provisions and looking at all the due diligence to come to the conclusion that if the IRS were to look at this, that the equity investor would be respected as a partner. So when we draft exit provisions into documents, we really have to balance, what we think our business deal is and what the tax law allows us to document. So one of the bullet points here, it says equity investor must be respected, right? So it says downside risk and upside reward. Well, what it means, there's lots of litigation and guidance about what it means to be a partner in a partnership. But in general, you need to be subject to upside risk and downside risk and upside potential reward, which means that if this project doesn't work and is lost to a foreclosure, you're the last one to get any of your equity back, and there's no guarantee that you would. And on the other side and the upside, if somehow the location of the property becomes the hottest property, in the city or the locality where it's built, and all of a sudden there's some real value here, well, the investor needs to be entitled to participate in that value. So it's easy to think, oh, the business deal is they're just going to get 10% of nothing or whatever and try to draft that way. Or they're going to exit for a certain price and that's it. We're not going to look at the value. But you really can't do that because these tax concepts really play a big role, and they kind of dictate, what you can and can't agree to upfront, can and cannot agree to upfront. So although year 15 and exits are super important, and we do want to keep an eye on them and draft and close deals to put people in the best position possible, what we don't want to do is do that at the expense of the tax credits. I mean, the tax credits are the heart of the deal. That's why the investors putting money in, putting equity in. So we don't want to do anything in this partnership agreement that makes a great scenario for year 15, but in the interim calls into question whether the investor is even entitled to these tax credits. And that would be very bad for the investor, but it would also be bad for the developer because, as you're probably familiar, the developer makes certain guarantees to the investor. So even though there's not any real estate, that they have a mortgage on, they're relying on the guarantors to make them whole if something goes wrong. So you as the developer, assuming people here are developers, which I'm not sure, but as a developer, you really want to make sure that these provisions are respected and that the investor gets the tax credits, because it could come back on your guarantee if something is challenged and they turn out that they don't get it. So, having said that, let's use those tax concepts and move into what investor exit provisions might look like in the equity document. So the most straightforward provision in the equity documents, the most straightforward exit provision would be an investor will typically have a unilateral right to put its interest to the partnership or to the general partner for a nominal amount. And that nominal amount sometimes could be $100, it could be $1,000, it could be $10,000. That's negotiable, but it is generally just some kind of nominal amount that you've agreed to that really doesn't bear any relationship to fair market value. And that is okay because it's the investor that decides whether they can whether they want to exercise it or whether they don't. So sometimes developers will think, well, if they have the option, to put their interest for $100, then why shouldn't we be able to make them do that? Why can't we say that we opt, for them to put their interest? And the reason is going back to the tax concept. So the investor needs to be considered a real partner with upside and downside risk. It's perfectly fine for the investor to decide on its own that it wants to exit and it wants to do so for a nominal amount. That's a negotiated transaction and that's fine. But for the developer to say, well, you will be getting out for a minimum amount in year, 10, 11, 12, up to 15, year 15, then that calls into question whether the investor is really a partner at all, because the developer can force them out and they won't have any way to get their fair market value. So it's okay if they decide at the time to give it up, but it's not okay to say we're going to force them to do it. So, and I have here that they can exercise this after the 10-year credit period, and that's true, and that's also something negotiable. It used to be in previous years, like a ways back, that in order to exit the partnership, you would have to post a bond, a recapture bond, if you did it before year 15, if you did it after year 10 and before year 15. That's no longer the case. So investors are free after year 10 and they've claimed all the credit to exit. That won't cause a recapture. They don't have to place a bond, but they will be subject to potential recapture for for another 5 years. So that's, but they can do it, but they don't have to do it. So a lot of times in agreements, this unilateral put right will be phrased that they can exercise it after year 10. But of course, there's no obligation for them to do so at any time. And they can certainly also wait until year 15 to do it. It's really up to them. But it does give you a little more flexibility for timing. Okay, so that's the most straightforward. And I think people go into these things hoping and thinking that the investor will exercise that. And I think the investor may intend to do that in certain cases. But again, this is the most we can document that they will have the right to do it if they choose to do it. So in terms of what the developer can do to force an investor to exit, there's usually a fair market value purchase option. So, and that would usually apply to either the property, so that the developer, GP, or an affiliate can buy the property, or they could buy the investor's interest in the partnership. And that's generally what we would see. So usually the project entity stays in place, but the investor's interests, the partnership interest, gets sold. And again, this has to be at a fair market value because it's at the developer's option. So we can't sort of undercut that fair market value concept. And we can only exercise this generally can only really force this after expiration of the 15-year compliance period, unless for some reason it's negotiated and the investor agrees that this could be exercised after year 10. So there's a lot of differences, and sometimes when you're drafting the fair market value purchase option, there's some tension as to, well, how do you determine fair market value? So partnerships agreements will usually say either the parties will agree on an appraiser, or each party appoints an appraiser, and then they appoint a third appraiser. So there's usually a process in how to get someone to value this and what criteria they have to they have to meet in order to be the right person for this. So And then there's also tension about, well, what do we put in this agreement that the appraiser should take into account when they're valuing? Because of course the developer is trying to get as conservative a value as possible so that there's not a lot of back end to try to have to split with the investor. So, what can we tell the appraiser? Can we put in our operating agreement that that they should look at the ongoing use restrictions on the property, that they should, consider various things like, if there's a tax abatement, if there's certain financing, or, look at investors' interests and they can't force a sale. So you should take that into account. And I think there's just tension because, again, this is supposed to be a fair market value by, a qualified appraiser. And so the continuum seems to lead towards not saying too much, because if you give really specific instructions to the appraiser, then the question becomes, the question becomes, is this really the fair market value, or are you controlling it or contriving it in some way? So I think you may see certain things in a document that the investor feels are okay, but you may also get some pushback and say, well, let's let the appraiser who's experienced in evaluating this type of project, let's let them consider what they know to consider and come to a fair market value. Yeah, so basically you're, again, going back to the tax concept that you don't want to limit the investor's upside by not reaching a true fair market value. So the next thing to talk about is the valuing of, so like I said, most times the property is actually not transferred. It's really the investor's interest in the property that get transferred. And the question is, well, how do you value that? And oftentimes an agreement will say that it's valued based on using the same methodology you would use to value the property. But what happens is, if the investor is supposed to get 10% of the back end, then you would take the value of the property and you'd see what the investor, if you sold the property, what would the investor get? And that's the value of the investor's interest. Sometimes you do sometimes it provides for a separate appraisal of just the interest, which you don't look necessarily at the property, but you look at the interest itself. So there's different methodologies to come up with, what is the value of the investor's interest if we're not selling the property. And one of the most common, well, not most common, but this has been coming up more and more about how you value that. And right. And so one of the things I noted here is that the actual split of the proceeds, or what the price turns out to be, is again can be affected by a capital account balance. So even though the business deal may say that you're going to split the back end 90-10 in favor of the developer, if the investor has a positive capital account balance, that can dictate, for tax reasons, how the proceeds are actually distributed. So what happens, surprises people sometimes, is that at the end of the day, you think that maybe there's $1 million to split, and that 900,000 is going to the developer and 100,000 goes to the investor, but there could be tax reasons connected to the capital account that may make it so that the investor would get a lot more than the 10% that you were thinking about in the business sense. So that's why it's important to keep a tab on capital accounts and see what's going on. Look at it in the projections from the beginning, because it can have an impact on the price that is required to get the investor to exit and transfer their interests. And I know that's a little high level, but it does occur. So it's just something to be aware of. So one of the main things we talk about when we talk about year 15 is a nonprofit right of first refusal. So that comes up a lot. So that is something. So I know we've been talking about the concept of fair market value, and the investor needs to be treated as a partner. So we really can't do anything that's below fair market value. But the code actually allows this provision to not have to refer to fair market value, and it's in the Internal Revenue Code, and it says that there can be this nonprofit right of first refusal to, a nonprofit developer or co-developer, and it can be what's referred to sort of as a bargain purchase price. And that's the next bullet on the slide. So that this is a right that the nonprofit may have to acquire the property. And again, this is for the property at the end of the compliance period, which is the 15-year period, for a minimum purchase price equal to outstanding debt plus exit taxes. And this is just kind of summarized to say that, but that's basically what it comes down to. So if you have a nonprofit and you have a nonprofit right of first refusal that you're able to exercise, the price for that wouldn't be fair market value. It might be something less if there is outstanding debt and that you'd have to either pay that or assume it, but that's a component of the price, or the exit taxes that we talked about before. So if the investor has a negative capital account and there's going to be exit taxes, that is part of the price for the right of first refusal. So so we were saying, so the negative capital account affects that price. So it's important to keep that in mind, again, looking at capital accounts, because if a nonprofit thinks that it has this nonprofit right of first refusal that it's going to exercise in year 15, right after year 15 is over, that is great, but the price may not be what you expect. And if you end up with a much higher price, you may not be able to exercise it because you may not have the funds to do it. So we have to make sure that, number one, we draft the right of first refusal as favorably as possible, so that it holds up and can be exercised, but also that we don't lose sight of the capital accounts, so that we don't end up with a purchase price that's way higher than we anticipated. So getting back a little bit to the right of first refusal and why there's so much confusion about it, it's really because it's in the code. It's described as a right of first refusal, but it's not defined. So there's a lot of question about whether, what does a right of first refusal mean? Is it the equivalent of what we might think of something under state law, which could require someone else to make an offer, and then you come in with your right of first refusal and get to use your bargain price? Or is it more akin, like, did they really mean to say a purchase option, meaning that at the end of 15 years, the nonprofit can decide, hey, end of 15 years, I have this right of first refusal, I want to exercise it and acquire the property for this price. So there's confusion about that. What does it really mean? What is a right of first refusal? There's a lot of, there's been a push over the years to get the law changed, or some regulations or guidance that says, hey, the IRS said I right of first refusal, but it's not defined, and what we want to define it as is more like an option. But that hasn't occurred yet, so we haven't had that change yet, although it's certainly always in the background of all the tax legislation that is being lobbied for. That's certainly something that is on our wish list, but it has not been changed as of yet. So there will be some confusion about what a right of first refusal actually means. And the other thing is that, the right of first refusal in the code specifically, specifically deals with, okay, so the right of first refusal in the code specifically deals with the property. And as we've talked about, a much more common scenario is to have the investor exit by transferring their interests. So the right of first refusal that the nonprofit has, it refers to the property itself, but you may not want to have to transfer the property because that may have its own complications. But that's really what the right of first refusal is giving. It really doesn't apply to investor interests. However, certainly in negotiations, when there is this nonprofit right of first refusal, an investor could certainly agree to say, hey, we know the price under the right of first refusal would be X. We'd be willing, instead of having a transfer of the property, we'd be willing to put our, transfer our interest to the nonprofit for that price. So that's certainly something that an investor could agree to, but it's not something that the code is really talking about when it talks about a right of first refusal. So, yeah, so there's confusion, and there's been litigation, and there's a lot of, there could be bad actors that are entering the market that want to give nonprofits a hard time. So there's been a lot of litigation about, how successful they can be with that. And the key is really, to the best you can, to draft the right of first refusal as broadly as possible. To say, this is the intent that the nonprofit get this property, and, we want to interpret it as the law, as broadly as the law will allow, so that everybody's on the same page. And also, there's oftentimes you would put language in to say, if the IRS changes what this means, then this agreement will change, and we'll accept the broader definition, or we'll work with the more, beneficial terms. So it's good to you can only say so much because the law is what it is. However, you want to be clear and do it as broadly as possible with as few restrictions as possible on the nonprofit, because you really want the nonprofit to be able to exercise that right. And I should say, and it goes without saying, that that's not always the business deal. A nonprofit sponsor, I think that would be generally the business deal, but there could be deals with for-profit sponsors and nonprofit, joint venturing, and it may or may not be the intent that the that the nonprofit would have that right. So that's something to be decided between those parties. But to the extent there is one, we have to be careful. We want to make sure that we draft it properly and as most favorable as we can. Okay. Oh, another polling question.
Yep, another polling question. This has been such good information so far. So our polling question is, what triggers exit taxes? Is it negotiations between the developer and the investor? Is it that the partnership reaches the end of the 15-year compliance period? Is it an interest in the partnership is sold to a related party? Or is it that the investor has a negative tax capital account balance? Looks like we've gotten a lot of responses so far.
Yes, and I'm so pleased that 38% have been listening. No, I'm just kidding. I know some people aren't doing the CLE, or the CPE, so it doesn't matter what you answer. But as we talked about, a negative capital account is the reason that you would have exit taxes, most likely. Okay.
Yep.
Okay. All right. Well, then I'm going to pick up the pace a little bit. And certain things that, let's see, I guess I'll switch the slide. Okay. So we've talked about drafting and business arrangements and good relationships with our investors and ongoing business deals and having everything the best we possibly can when we close, keeping track of everything. However, the best laid plans could be thwarted because investors may go out of business or be acquired. You could end up, for example, we had a deal where it was a local bank that was the investor. They had a relationship with the developer, a banking relationship, and did this deal in connection with that. And the bank was sold, twice and by the time we went back for the year 15 discussions, we had a bank there that didn't make this investment, knew nothing about low-income housing tax credits, knew nothing about what the intent was, only saw the documents, and they were done as best we could. But, that can happen. Even if you're dealing with the original investor, there could be business changes there that have occurred. So, these are just things that could, make this process a little more complicated. And there could also be investors could go ahead and have their portfolios sold, or they may go out of business and sell their portfolios, or they may take certain portfolios of theirs and sell them to other investors. So I think I alluded to it before, but this is a big issue. Aggregators, they can be referred to as bad actors. They're people that come into the industry. They're not the people that close the deals or put the equity in, but they're people that people that come in and they want to squeeze every last dime out of these deals. They look for things, they can look at the documents and see technical defaults that, a normal investor would not be pursuing, but they can find things. They can say, well, there's all these fees that you owe. And while the original investor may have waived those, now all of a sudden this new investor is saying you owe them. And it can just make it very difficult to, in year 15, especially because the purpose of these investors is not to make it easy for you, but it's to get as much as possible as an exit price. So the only thing we can really do about that is to make sure that we, draft as much as we can to, make our intents clear to the extent we can, but also to maybe put some guardrails in that the investor wouldn't be able to transfer their interest without our consent. And maybe we say something to the extent of, in order for you to transfer your interest, you'd have to get the general partner consent to that. And then there's a negotiation. Investors don't want to be constrained that way, although they will usually admit that they're not intending to transfer to any aggregators or bad actors. And they may not be, but 15 years later or in the process, we just don't know. So they may be willing to put something in about we won't transfer to these types of other investors, stuff like that. So you try hard to get as much discretion over it as you can as the general partner. But that's a negotiating point, and you may have better luck if you're a bigger developer and you have a lot of deals with this investor. So it's something to be negotiated and to be remembered. But yeah, so even the best laid plans could be derailed. And this is just the next slide is just about mechanics of dealing with people in year 15. So you have decision makers. Who makes the decision? Who are you talking with? There's usually a whole set of people that deal with these exits. And we haven't talked about the difference between a direct investor, which would mean like a bank directly, like if Bank of America or Sovereign or Santander or Bank of America, or you're in direct investors, then you're dealing with Bank of America. But more often, it seems, there are syndicators in the middle that kind of close these deals and then compile them into a portfolio of deals and then put in an investor up top. So in that sense, you kind of have two levels to work through. So if you have a syndicator that has a fund where your deal is and it has multiple investors in that fund, they may have more discretion. It just depends. So there may be more discretion at the syndicator level to make a decision on this because there's so many investors, it would take a lot of time to get input. So they may have more authority. But if you just have a proprietary fund, which means you have one kind of director, so one kind of investor. So if you have a fund and it's all Bank of America or US Bank, then they may have more input in deciding what's appropriate for an exit price. So you're not only dealing with your syndicator that you might know from closing and asset management, you may very well have another investor up at the top there. So once we get to the point where we are agreed, how do you document it? So documents often include a transfer agreement because, like I said, we're mostly transferring the investor's interest. So there's usually a transfer agreement where you agree on the terms of that transfer. And then at the time of the closing of it, there's usually an assignment from the investor to the general partner, developer, affiliate. And then you usually would amend your equity documents to show that the equity investor is withdrawing and, taking out sort of all the investor type provisions that are in there because there's really no need for them anymore. And as I said before, that can happen, either after year 10 or you're 15. If it does happen prior to your 15, the documentation would look a little different because, like I said, there's still that 5-year potential recapture period from year 10 to year 15. So there'd probably be a lot more information required for the investor over that 5-year period. And they might say in the transfer documents, okay, you're going to keep giving us reports for this 5 years because, you know, we still need to monitor our investment. Even though we're out of it, we're still subject to recapture. So they're probably going to say if you had a tax credit guarantee in place, it's going to remain in place because, again, they have that 5-year window where they're still subject to recapture. So it'll differ a little bit depending on the timing of the exit. There's important to remember to think about, ask somebody about the transfer tax implications of transferring an investor's interest. And that's because there are state rules. It depends where your state is and where your locality is, but there are different rules. If you transfer an interest in a company that owns real estate, you may trigger the same type of transfer tax that you did if you just sold the property outright. So, yeah. And another thing to keep in mind is that you just want to make sure you have the appropriate entity on your end to, acquire the investor's interest, because usually you would like the partnership to stay in existence and you don't want to use the general partner entity to acquire the investor interest, because then you'll only have one partner and it might dissolve for state law purposes. It's just complicated. So you might want to take a separate affiliate to buy those investor interests. And also another thing to remember when you're doing this is you're not kind of doing it in a vacuum. You have to really consider, do you need other people's consents for the investor to exit? Check the loan documents. Do you have to notify the state agency that, investors exiting, there's going to be a change? Is there any HUD requirements? Anything, just think about, anything that might impact you when you're doing this. So although it's tempting just to think about the investor in year 15, just kind of see it in the bigger picture and make sure there's nothing else that needs to be done in order to effectuate that. And I have gone way too long. So I will just leave Elizabeth a few minutes, but I do want to give you my key takeaways from this. One is that, as we talked about, tax issues play a role as well as business issues. Drafting, it's all a balance. You need to draft in a way to make it as advantageous as you can. However, it's not worth making it so advantageous that something impacts the tax credits, and that could lead to bigger problems. So just be aware of that. Also, a focus on the financial projections as early as possible. Like I said, in connection with the closing, you want to look at those. The investor sometimes does their own projections if the developer doesn't have an in-house accountant or accounting department. So you want to ask for those and take a look and see what capital accounts are projected to be and if there's an issue that you need to address. And the last thing is, it's really helpful when you're looking for an investor and you're doing the LOI process to tell the investor at that time that this stuff is really important to you, and put as much as possible in the LOI so that when their attorney starts drafting equity documents, they know that you've agreed to this stuff. Because usually, equity documents start out from a form and they're usually, a certain way. And if nobody says anything, then those agreements are going to stand. It's much easier if it's in the LOI to have a change made than to say something in the LOI that you didn't really mean, and then you get the documents drafted that way and it's harder to change it. You still can change it at that point, but it's easier when you have a little more leverage to just make it known that you want to put some provisions in the LOI to ensure that the documents get drafted the best way possible. Okay, Elizabeth?
Thank you, Penny. That was a lot of information, great information for sure. And we really appreciate you helping us out today and talking on our webinar. I'm unable to, there we go. The final polling question. After getting through all of this, when I read through it, I think I might need some chocolate after this. So I thought we could just ask, what is your favorite type of chocolate? Is it dark, milk, white, or ruby? I just found out that there is such a thing as ruby chocolate. So I think I need to investigate this at a fancy candy shop and give it a try. But anyway, if you could get your last polling question in, and while you're doing that, I just want to thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, you can reach out to either Penny or me. We did have a question that came in, so maybe once we get through these last few slides here, we can address that for anybody who wants to stay on. Just a couple notes here. A recording of today's presentation will be posted on our website and social media sites in a few days. And if you requested CPE and answered the polling questions, you'll get CPE certificates via email within the next month. And we hope you'll join us for our upcoming events, which include a state and local tax update. Registration is open for that now on August 27th. Our affordable housing seminar in person, which will be in Mechanicsburg, Pennsylvania, is November 5th. We'll have AJ Johnson here for that. That's always a really great event. And finally, our affiliate company, MLCM, we are having training on August 12th for calculating income and assets. So thank you again for joining us today, and I hope you have a great afternoon. Our last question, or our only question that came in here today, is how about the for-profit developer who is a co-GP with the nonprofit? What would they be entitled to under this nonprofit right of first refusal?
Yeah, so I'm happy to answer that quickly. I mean, from what I can tell from the question, I mean, yes, as I alluded to, there could be joint ventures with, with for-profit and nonprofit, and that is really a business decision, like whether it's intended for the nonprofit to really take the property at the end or acquire those interests. So the code allows this for a nonprofit only. So a general partner is a for-profit entity would not be able to take advantage of that bargain purchase price. That's strictly a nonprofit, but it's not something that is automatically given. If that's not the intent, then the general partner, there just wouldn't be a nonprofit right of first refusal, and you would just go the fair market value route. I hope that helps.
Thanks, Penny, and thanks for everybody who stayed on, and thanks again for joining us today, and we hope to see you at future events.